Yo, so in this video I want to talk about the bull and the bear case, just to go back and forth and bounce some ideas. Now, I think the bear case here is so strong that it makes no sense at all to be bullish. The only valid bull argument, there are plenty of bull arguments, but the only valid one that is hard to debunk is FOMO, which could drive the market way higher. And I'm not going to argue with that. However, all the other things such as rate cuts, QE, the Fed in general, um, whatever argument people want to make is not valid. And let's go reach one. So in the past 2.5 years, since this bottom here, keep in mind I turned bearish around here in December of 2021, saying the market was really overvalued, and then it went down, and then it went up, and now it's gone down here as well. Okay, so it's pretty much flat, and T-bills have beat the stock market since then. All right. But let's look at it from a trend analysis perspective. And it's really easy to debunk what I'm about to say here, because you could mention, what about 2018? You made a weekly lower low, and then you still went up to put in a higher high, and that's a valid point. And the same thing with 1998. So let's go over that and let's see if the macro environment is the same. We can also ask AI, ChatGPT in this case, okay? So let's do simple trend analysis, because the best case that the bulls had in the past couple of years has been weekly market structure. Now, first of all, let's look all the way since COVID. We put in the COVID low. We consistently made higher highs and higher lows. Right here, I'm just highlighting the higher lows. And you can see we're making these higher highs here as well. And then let's look at 2022. And this was the best argument that the bulls had, in my view, right? Was from a chart perspective, and I didn't fight this from a trading perspective at all. I just think it's a Ponzi that's gonna collapse. But let's look at the similarities between this and 2022. Well, at some point here in 2022, you started putting in lower lows and lower highs, okay? Right here, you actually made a higher high. So you could even argue right here, if you make a slightly higher high compared to right here, it doesn't really invalidate much, because you had the same thing in 2022. But let's keep looking at this, okay? So this was the trend analysis in 2022 versus what we have now in 2025. So I think you can clearly see what's going on here, right? We have been putting in weekly lower lows and lower highs. So you might say, well, this is very simple stuff. Surely everybody understands what a downtrend or uptrend looks like. Well, clearly not, because a lot of people seem to think that we're just going to go back to new all-time highs now, which we could. It's not impossible. It's just not probable. Okay? And I'm going to make plenty of arguments for why it's not possible, and why this looks exactly like previous bear markets, major bear markets. Okay? But from this trend analysis perspective, let's just be fair here. Okay? What about right here? We were making these higher lows. Right here, what do we do? Well, we put in a weekly lower low, right? You could even argue right here we put in a weekly lower low, right? Compared to right here. The issue here is that GDP was not contracting and unemployment was not rising, and the yield curve had not been inverted prior to this, and we were not in. Actually, we were in a rate cutting cycle in 2019, but right here, if I remember correctly, it wasn't in 2018 that the Fed funds rate was going down. Exactly, it was here in mid 2019. Okay? So there's a lot of differences compared to right here. Alright? But then you could argue right here that right here we started putting in these higher highs and higher lows. Alright? Which that was valid. Up until right here. So was it over there? Well, I mean, temporarily, yeah. But then a new uptrend began. Right? But simply from a trend analysis perspective, this doesn't look great. Okay? And so the reason why I think this is going to result in a lower high is because it's similarities to the past. And again, what I want to bring up is the following. First of all, let's look at the Fed funds rate. In blue, we have the 2-year Treasury yield. So what controls interest rates? Well, it's supply and demand in the bond market. Whoever is lending their money out to the US government is going to demand either a high or a low interest rate. The Federal Reserve cannot influence that. They can psychologically, but mechanically they cannot. They simply just follow the 2-year Treasury yield. So what I'm talking about is the blue line being the 2-year Treasury yield, and the red/orange line, I'm colorblind, my bad, follows the 2-year Treasury yield in blue. Okay? So the 2-year Treasury yield goes down first, Fed funds rate follows. Up first, Fed funds rate follows. Down first, Fed funds rate follows. Up first, down first, up first, down first, up first, down first. Right? So this just goes to show that the Federal Reserve is not in control. It's the 2-year Treasury yield. So supply and demand in the bond market. So let's think about this. If you buy a bond, the price goes up. The interest rate goes down because it's mechanically 100% inversely correlated to the bond price. So what do interest rates reflect? Growth and inflation expectations. Alright, so if the argument here is just getting into the second one, the second bull argument here. What would make interest rate cuts bullish versus bearish? Well, mechanically, it's bearish. And a lot of people have this backwards, and I'm going to explain why. It's very simple. If someone is selling bonds, which is why interest rates go up, that means they're either concerned about A, inflation, or B, growth. As in, they're not concerned about growth, but they're expecting growth. So they want to take an additional risk by selling their bonds and getting into risk assets to be compensated during a growth period in the economy. Alright? So let's think about how this plays out. When interest rates go up, it means that there's growth and inflation expectations. Inflation is bullish, just not when you have too much of it. You want inflation to some extent for economic growth. Lower inflation leads to lower interest rates. The sequence goes as the following. The money supply moves first, then inflation comes with a lag, and then interest rates react to the inflation. Right? So it's all about the money supply in the beginning of this sequence. And so why would rate cuts be bearish? Well, just think about it. If it's not the Federal Reserve that controls it, and you can see simply here that they just follow the 2-year Treasury yield, then how could they possibly have any positive impact when all it means is that people are fleeing into the bonds because they're concerned about growth, and the opposite of inflation expectations, as in they're concerned about potential economic contraction, which is why they flee to a safe haven, which is bonds. They're playing defense. So when people get out of bonds, it's bullish. Interest rates rise because of growth and inflation expectations. When people flee into bonds, it's bearish because it's the opposite of growth and inflation expectations. So let's just make sure that we understand that correctly. Alright, now going back to the stock market. You can clearly see the difference here between this and 2018. Right? Interest rates were rising here, then going sideways. You were not in a rate cutting cycle. So this means that the economy was strong. Alright, what do we have right here? Yes, the stock market can still go down even when interest rates go up, but that doesn't mean it's because of the interest rates going up. Everyone thought that, but that's not the reason why. Okay, because after that it went up. Same thing with the pause here, it can be bullish, but when they start cutting, it's not bullish. It can be bullish for a few months. Right here was bullish for a few months. Right here was bullish for a few months. Same thing if you look at the 2008 cycle. Bullish when interest rise, and when they pause, really bearish when they go down. Okay, so there's a consistent pattern here. We can go even further back, which I'll do later in this video. So I don't think this is like 2018. And in 2018, GDP was not contracting the way it is right now. Unemployment was not trending up like like it is right now. And what I'm referring to is this. To make this visual for you. Look at the weekly chart, okay? Look at the unemployment rate in purple. Was unemployment trending up here throughout this period? No, it was trending down. Here it's been trending up, okay? As the Fed funds rate is dropping. That's the same as right here and as right here. So 2018 is not the same, okay? All right. Now what we need to do is we need to go to the S&P 500 chart right here to get more historical data. Let's put this on log and let's overlay the Fed funds rate and the unemployment rate, okay? So again, 2018, this looks nothing like this, okay? Interest rates were going up / sideways during this period. It's not the same as here, okay? When interest rates go down here, let's start from here. When interest rates go down here, stocks initially go up, then down. Interest rates go down here, first up, then down. Interest rates go down here, initially, up, then down. When interest rates go up here, it's bullish. When they go down, initially the stock market during, well actually here it was rolling over instantly, okay? But it was because the unemployment rate was going up. Unemployment rate going up, unemployment rate going up, unemployment rate going up, okay? You can see it, the unemployment rate has been trending up, alright? So the bull case here is very weak based off of rate cuts and trend analysis because it's nothing like 2018. But what about in 1998? You can see we made weekly lower lows here. So was it over? No, but again, let's look at this, okay? Rates were going down, okay? Unemployment was going down with it. So therefore it was bullish and the bull market could resume. Okay? You can go even further back if you want, but let's just look back at the past 30 years. Now, the second bull argument that people make, because now I've talked about market structure, rate cuts, the next one would be QE. Alright, everyone just ignores what happens historically during QE. Here is the Japanese stock market. As you can see here, the Nikkei fell from 1989 to 2001 by 66% for 12 years. And then the Bank of Japan introduces QE here in March 2001, and the market fell another 47% from there. And the Bank of Japan calls it ineffective and rejected its use for monetary policy, stated that QE is not effective. They buy stocks and rates are zero this whole way down. Just goes to show that rates going down is bearish. It reflects the opposite of growth and inflation expectations. Okay? Very simple. What about historically with QE? QE began here in November 2008. QE1 began here. And the stock market from late November, which was right here, went down 26% after QE began. So the market is down, QE begins, markets drop more. During QE2 and QE3, the market was in an uptrend. During QE4, QE Infinity during COVID, we got it right here during an emergency meeting. And the market opened down 12% after QE was announced. So it dropped another 20% after QE4 began. Okay? So the history of QE states that QE is not very effective. We can go over it mechanically as well. Right? Now, let's overlay the Fed's balance sheet. Fed balance sheet. And let's see if these arguments are true. Right? That QE is bullish and QT is bearish. Because QT has to be bearish if QE is bullish, right? First of all, when I mouse over this, you're going to see the number here in trillions, okay? So here, exactly in May 2015, 10 years ago, the Fed's balance sheet was 4.5 trillion. Today, it's 6.7 trillion. So it's gone from here to here. And the stock market is up how much since May of 2015? 170%. So the Federal Reserve increased their balance sheets by 2.2 trillion, from 4.5 to 6.7 trillion. And the stock market went up 170%. How much is that in market cap in trillions? Let's do the calculation. Here's market cap to GDP. Yes, this is Wilshire 5000, but it's good enough. Okay. Let's scroll in and let's look back to May of 2015. Market cap to GDP, 120%. At its most recent peak, it was 205%. I think it was even higher if we zoom in even more. I was 205%. Okay, 205% market cap to GDP. So what is US GDP in 2025 in trillions? 30.5 trillion. Okay, so if US GDP in 2025 is 30.5 trillion, and this percentage was 205% of the peak, that means that the stock market was worth over 60 trillion. Let's say 62 trillion or so. But now we just got GDP contraction. So it was more like 62 trillion or so. Do you think the stock market went up from, let's say, a market cap of 20 trillion to 60 trillion up here because the Fed, quote unquote, created 2.2 trillion? The math is not mathing. So the history of QE goes against the bull case. QE1 was not bullish initially. Markets dropped another 25%. QE4 was not bullish initially. Markets dropped another 20%. And then we can look at Japan. And you can see what happened when they did QE. QE doesn't matter. It's a fallacy. And I just gave you the math behind this. Okay? Now let's be clear. When the Federal Reserve increased their balance sheet, that doesn't mean that the money supply goes up with a 1-to-1 ratio. If the Fed's balance sheet goes up 2.2 trillion like it's done since May of 2015, does that mean that the money supply went up by 2.2 trillion because the Fed contributed towards that much of a money supply expansion? No. The Federal Reserve only accounts for roughly 14 to 18% of money supply growth. The rest is commercial banks. So the Fed is fairly relevant here. Which is why when everyone brings up QE, it's a silly argument. And I just showed you the history of QE. Alright. What's a bullish case from the perspective of the market could go higher? FOMO. Could the markets go higher because everyone is feeling FOMO and everyone piles into leverage ETFs? Sure, it could. It's just the probabilities in general with everything we're talking about is stacked against you. What is another argument that people like to make? Let's look at the unemployment rate. You could argue this is low. Look, the unemployment rate is very low. Right? The issue here is that you're not getting it. Here is the historical examples of unemployment rising in these scenarios and how much the unemployment rate had to rise for you to go into recession. 0.4, 0.1, 0.6, 0.6, 0.3, 0.5, 0.7, 0.5, 0.5, 0.4, 0.6 instant. Currently 0.8. So you could make the case, well, unemployment rate is low. Right, but it's low in all of these examples. Let me remind you how much it takes for the stock market to crash by, let's say, 50% in the past 350% bear markets, okay? Unemployment rate, let's overlay it. When I mouse over this number, it's going to tell you it right here. 4.4%, okay? So unemployment, U3 unemployment rate was 4.4% in May 2007. For the markets to drop by, let's say, 50% from there, unemployment had to go up to what? From 4.4 up to 6.5 to 6.8. So that's a 2.1 to 2.4% rise in the unemployment rate led to a 50% stock market crash. What about in .com? 3.8 right here. Stocks crashed from there by 50%. And the unemployment rate had risen from 3.8 to what? By the bottom, 5.8. A 2% rise in the unemployment rate led to a 50% stock market crash. What about in 1974? Right here, 4.6% unemployment rate. By the time the stock market bottoms, it's 6%. So let's say from here, right? Unemployment rate goes up by 1.4% and stocks go down 46%. So that's also a bad argument, that the unemployment rate is low, so therefore it's not bad for stocks. Alright. What about the people who are now coping saying, well, GDP was only negative because of gold imports and so on. People front running the tariffs. Okay, but I could make a counter argument to that saying 38% of US GDP is government spending. If we never had government spending, GDP would have been negative every single year since 2008. So that's also not a good argument. So you're not factoring in the 38% government spending. Alright. What about the VIX is low now? The VIX is going back down. You could have made the same case in May 2008. Look at this, okay? Where was the S&P 500? What are we making a comparison to with this right here? Keep in mind, high correlation to past bear markets. Yes, the pattern of price action macro backdrop is highly correlated to 1973, 74, 2000, 2002, and 2007 to 9. Initial 20% drop, 15 to 20% bounce. Lower height, 7 to 10% below the all-time high. Happening in that bear market, this one, and so far it's also happening. You had negative GDP in all of these examples, rising unemployment, deflation / disinflation. So it's not just similar, it's arguably a textbook bear market setup. And you want to know what AI is saying now? According to ChatGPT, my view, the April 9 surge likely marks a typical bear market rally rather than a new bull phase. Alright? What about the VIX is now low? Right, the VIX was at 15, 16 here in May 2008. Guess what? On this lower high. 20% drop, big bounce within 8% of the all-time high. Alright, what have we just had right now? 20% drop, lower high within, again, we can measure these out for you, okay? 20% drop, and then the, did not mean to do that. The lower high was 8% away from the all-time high. Okay? 22% drop. The lower high so far, 8% away from the all-time high. And now we're rejecting here. At my target, 5650 to 5700, which is what I spoke about for a long time. But what if you go even higher? Right? Because you could, like anything is possible. I don't think it will. You did right here. Look in 2022. You got 24% of the all-time high. It was still not over. So if you repeat 2022, you could go to 5900 and it's still 2022 bear market. But that was not a recession. And that could have probably looked a lot worse if there was a recession here. Okay? And what about these other examples throughout history? Right here. You had this initial 20% drop. Then you bounce back to within 11% of the all-time high. Still roll over. What about in 1973-74? Initial drop here, 18%. The lower high, 7.2% away from the all-time high. Then you rolled over. Okay? So it's just not a good argument. The VIX is low, we bounce back hard. You do that in every single example. So I don't think any of these arguments are good. And the VIX only gets up here during bad times, guys. 2008, 2020, and now. The GDP is contracting, unemployment rate is rising, we have a very overvalued stock market. Now, let's look at the market cap to GDP from a bullish perspective, because one can make the case, right? We need to consider all possibilities. You could have made the case that it was, again, if this is mean, according to this, and this is the best indicator according to Warren Buffett, probably the best single measure of where valuations stand at any given moment. And he's in all cash. Well, not all cash, like 1/3, like $350 billion is in cash. Okay? And literally said that there is nothing to buy. If mean is 80%, let's say, okay? Or 85%, you could have made the case that it was overvalued here all the way since, let's say, 2013. Was it a bad time to buy stocks in 2013? No. Okay, so what's the difference now here versus right here? It's not a timing signal. It's just to show you that the market is overvalued. There's a lot of hype here. And there's a lot of cope going on. Okay? And so the bull case here, while yes, for this, you could say that we could just go higher, right? You're playing with extreme fire, as Warren Buffett says. Playing with fire. Here's the quote. If the ratio approaches 200%, you're playing with fire. So that's all we have when it comes to this, right? To say that, okay, well, we're playing with fire here. You think he said that for a 20% drop? Well, why didn't he buy the dip? He didn't buy the dip here. So there's a saying that's going around on Twitter now. If Warren Buffett ain't buying, I ain't buying. Historically, you need unemployment to spike. You need the VIX to spike and to stay high for a while, right? When unemployment rises by 1.5 to 2%, it's gonna continue rising most likely, but that could likely be the bottom. The market's bottom way before the unemployment rate peaks, but it doesn't bottom right in the beginning of the unemployment rate uptrend. It's after it's risen by 1.5 to 2% historically. Unless you're going into depression, because then the market could keep selling off while unemployment rate makes new highs. Alright? So I think I've gone over most of the things here. Let's go over this little thread I have here regarding inflation. Because again, we have CPI, month over month. Trading economics. We have deflation in the CPI. Right? Which this should not come as a surprise to you. And same thing with when it comes to the PPI month over month. Also deflation. Shouldn't come as a surprise to you. The money supply is growing at 4.1% year over year. We had a contraction prior to this from December 2022 to March 2024. Okay, what I'm referring to is this. Let's bring up the M2 velocity as well. Alright, let's do percent change from a year ago. There was a contraction here in December of 2022 to March of 2024. That should show up with a lag, which is what I'm pointing out here. So you need a 6.3% M2 growth rate year over year to get 2% CPI, and you guys are really worried about inflation. Why? Monetary inflation is not the same as asset price inflation, which is not the same as consumer price inflation. Why 6.3% M2 growth rate year over year? It's about money velocity. Real GDP and the natural state of the economy is deflationary, as capitalism leads to us producing more goods and services. You know what this means? And what this reminds us of? Look at the Great Depression. Downtrend in the money velocity. You had the same thing right here. M2 growth rate in year over year in February of 2021 was 26.7%. The CPI was 1.7%. Why? Lag effects. Right? So it's the same thing right here. So the money supply contracted here, as I showed you. What do you think happens with the lag? Deflation and depression. Not this time, bro. Are you sure? It's 100% probability based off the past 200 years. Here's the calculation, right? So you got to include the money supply, the velocity of money, the price level, and real GDP growth. Now, Steve Hanke, which is the professor from Johns Hopkins University, is a professor in applied economics at Johns Hopkins University. His calculation is 6.3% because he takes into consideration 2.5% money velocity, M2 velocity, as it says here. And if you use what other people use, which is on Steve Hanke, then it would be 3.8 to 5.7%. Okay. So again, it's the difference between 2.5% versus 1.9% M2 velocity. Alright. Okay, now I think I've gone over everything in this video. So again, I'm expecting the S&P 500 to collapse, because this is where it historically collapses. And I made the case on my Twitter, right? Where is it? Look at this. Being excited right here with where we are right now is the same as being excited right here, right there, right there. And it's based off of history, right? I'm referring to this. You have done everything. You have filled all criterias for a 50 to 70% crash. You gotta go above it. You gotta make any all-time high soon. Otherwise, doom is imminent. And why is it struggling so hard here at 5650 to 5700, which is what I spoke about since 5220 right here. I said right here, it likely goes up to here. And over here, I was bullish as fuck, right? I go back and watch my previous couple of videos, talking about how it's gonna squeeze above these highs. But now, I literally think it can go down in a straight line, down 50%. Right, so that's all. Take care, peace.